What is going on, everybody? Troy Marsh here with Marsh Home Group and KW Consultants. Quick start here on our new website at marshhomegroup.com. Go check it out. Hopefully, you guys like it. You have the ability to obviously search for homes, some information about selling, and then also you can come in here and get an instant home valuation at any time. So definitely would love for you to check it out. Again, marshhomegroup.com. And then I'll go ahead and jump into the update here on the housing market. So got a lot to talk about for May here. I would say the biggest trends are definitely inventory and selling trends, and then interest rates and affordability. And then we'll get into what all of that means. So real quick here on the current market, we can see the seasonality here with the market. And then we also see down here, if we look at what happened in April, don't get too caught up in the number for sale because that definitely depends on what day of the month is the last day of the month. Big number new listings were down 2.6%, solds down, but pendings are up. If we look at year to date, we see that basically the new listings year to date are even, and then the solds are down about 4.3%, but pendings are up. So basically what that means is that we're just selling more houses than what we have available in the market. If we look at median pricing, nationally, I think the average price was up somewhere in the 14% range, meaning April compared to April of last year. And here in Central Ohio, we were actually up 15.8% when looking at the average price. So the average active home in Columbus in Central Ohio is 432,000, and the average sold home was selling for 338,000. Those of you that have been following the market since the 2008 crash, when we were down below 200,000 for an active or for average sales price, pretty crazy. I would say this is the story, and kind of the next couple slides will continue to go down this path. So since January, you can kind of see it was pretty flat. This is what most of last year looked like, right around 3%. Actually, parts of last year were below 3%. But then right after the first of the year, rates started going up into the fastest climb that I've seen in my 17, almost 18 years in real estate. So we have average interest rates up a little bit over 5%, between 5.25% and 5.5%. And that seems really high, but if we actually put this into perspective based on history, you can see going back to the 1970s, we actually never went below 5% until sometime in 2009. And then ever since 2009, we actually almost never went back above 5%. So the last 10 or so years, the last decade, we've stayed in that category. But when you look at historic trends, we're still in pretty good shape. Quick slide here on affordability and what the rise in interest rate have done to people's monthly mortgage payment. So if you were looking for a house in December, maybe put a bid on a couple, haven't gone into contract or just recently went into contract, your monthly payment, depending on your loan amount, went up potentially pretty significantly. For a $300,000 loan, your payment went up by $351 a month. Obviously, this is not including taxes and insurance. And then on a $600,000 loan, it's $702 a month. So when we talk about affordability, obviously that interest rate plays into it in a big way. So when we're looking at affordability, this is actually March. So we were at 4.4% for interest rate. And that meant that the average family in the United States was spending 29% of their monthly income on their mortgage payment, which that's based on an average income and an average house at 4.4%. We can see in April with the rising rate up to 5%, that number went up to 31.2% of your monthly income would go towards to buy an average house in the United States. So an interesting number is that back in 2006, the highest that number ever got was this 34.1%. So we're getting dangerously close to what was kind of the peak of affordability. The other thing to remember, I think the average price in the United States is around $440,000. Remember, a couple slides back, we talked about in Central Ohio, it's $338,000. So we have probably a longer way to go compared to some of the other areas when we talk about affordability. In conclusion, with regards to the market, in my opinion of the market, I think affordability will continue to dictate when things begin to flatten out. And remember, affordability is dependent on what the average person makes. So even if you're not getting a raise by chance, somebody else might be. We have Intel coming to town with an average salary of $130,000. We're seeing people coming in from California paying cash for properties $100,000 and $200,000 over list price. And so that is likely to continue happening with what we have going on in our local economy. I do believe that some parts of the country, as I mentioned a second ago, will start to see a flattening out, could actually see a little bit of a decrease in pricing. And I think that's primarily going to be centered around areas that are very popular for second homes, because as interest rates get higher and monthly payments get higher, homes that people aren't using as their primary residence will become less attractive. But I ultimately believe that the rise or lack thereof in wages following the larger inflation and cost of goods in general will be a big factor in whether we dip into a recession or not. So obviously, if we see home prices continue to go up, but we see wages stay flat, along with your home prices going up, so is your food, your gas, everything else, we will likely see a slowdown in price appreciation, even in Central Ohio. My opinion is whatever slowdown happens will be relatively short-lived, though, based on the increasing population and lack of supply. But what things am I looking for in order to start raising the warning bell with regards to real estate and pricing? Definitely looking for lowering lending standards. If lenders, because they're not able to give loans out to as many people, start allowing people to do stated income loans and different things like that, we could be in we definitely are in a little bit of danger territory there. Certainly, if we're seeing higher days on market, which we're not seeing, that's actually lower compared to last year. The leading indicator of that is going to be more price reductions. Obviously, when we're talking about selling a home, it's basically location, which we can't change, price and condition. So if we start seeing price reductions, some of that could be due to people overpricing it on the front end. But if we see a significant number of price reductions, that's something to kind of raise an eyebrow at. Overbuilding, which we're far away from overbuilding. We're actually very underbuilt here. And then, as I talked about before, affordability getting out of control is definitely something that could cause a slowdown. So if there's anything else that you want to see in this, please leave a comment below if you're watching on YouTube. Otherwise, shoot me an email, give me a text, or visit our website, and feel free to fill out a contact card. We'd love to hear from you if there's some more information you want to hear here. And real quick, just want to thank my sources, mortgagenewsdaily.com, realtor.com, trendgraphics.com, and then blackknightinc.com is where I get that affordability data. So feel free to go check that out. If you're a data nerd like me, you may enjoy that. So thank you guys so much for watching, and have an awesome month. As always, if there's any questions we can answer about home improvement, whether that's going to pay off when you sell, whether it's finding out what the value of your home is, or maybe you're interested in buying some investment property, never hesitate to reach out. We'd love to help. Thanks so much, and have an awesome day.